thank you everybody for coming to my session. Ooh, that was fast. That's not, we don't want to go that quickly. This seminar, because I didn't see any blurb anywhere about a description or anything, so I want to make sure that you're clear. This is called Kreusen, little thing called cash. We are going to be talking about the cash flow statement, constructing a cash flow statement, taking you through a step-by-step way to do it yourself. So if you are a brewery that is greater than 5,000 barrels, you don't have any sort of financial responsibility within the company, this might not be the best fit for you. But if you are a small brewery owner, a startup, going through expansion, and trying to figure out a better way to manage your cash flow and projections and looking things for the future and making the cash flow statement a little bit more intuitive, this is the place. So, just wanted to make sure. See, don't want to waste people's time. Of course, a little thing called cash. I'm an Elvis Presley fan, so that was my little pun on my rockabilly background. A little bit about who I am. I live in Asheville, North Carolina, and I am a fractional CFO for our industry. I am originally from the Midwest. I don't miss the weather that much at all, but I grew up in the backyard of New Glarus Brewing. So I got to watch Dan and Deb Carey grow their business from the late 90s up until what it is today, and she's one of my mentors. So loved growing up in the Midwest for that reason alone, and I went to a small school in Dubuque, Iowa for my undergrad in accounting and business management. I moved to North Carolina in 2003, never looked back. Just love the weather, love having the beach and the mountains, and that's where I earned my master's. At that point in time, I was working for Caterpillar as their accounting and pricing manager. So I went from work tools and machinery to beer. And prior to that, I was working with a lot of small businesses. But my one stint that I had in corporate America with Cat, that's the only one I've ever had. I lasted a year and a half. I knew I wasn't a fit. In 2008 then, I was trying to figure out what my next direction is going to be, and was looking at craft beverage, was looking at coffee, wasn't sure which direction I would go, and lo and behold, Dogfish Head, this little unknown brewery, was looking for a controller, and they had created this brand new position for them, and so I interviewed, knowing that I'd have to move from North Carolina to Delaware, but I was like, love beer, love 60 Minutes, love the culture that they exude, let's see what happens. And I, along with 267 other folks, applied for that position, and I got the job. And so that was how I got started in beer. And between that stint and then my next stint at Mother Earth Brewing as their CFO, I got brought back to North Carolina. I realized that nobody was really fighting for the little guy. So over the 5 years, my first 5 years in beer, I recognized that Allagash has a CFO, a controller. So does New Belgium. So does, many larger breweries. But the small, the startup, the one that's going through its initial phases of growth, they did it. And so they were making all these different financial mistakes that were avoidable, that could have been avoided. And I was like, this is terrible. Because these are such great creatives that are making so many amazing products. If I could help them avoid some of these financial mistakes from the very beginning, hopefully we can move on and let their business grow. So I said, if not now, when? I'm just going to go out on my own and I'll act as a fractional CFO for the industry. So I decided to go on my own in 2013. My very first contract was a 5-month contract with a then complete startup, Creature Comforts in Athens, Georgia. So I was in their CEO, CFO role and got them to launch. We found Chris Heron at Diageo, brought him aboard, onboarded him as CEO, and then I moved on. Since Creature Comforts, I've worked with well over 300 different brewing entities, brew pubs all over the country, coast to coast, even in Alaska and Hawaii. Love it. I am grateful for every day that I have the opportunity to work within this industry. I have also served as the CEO of Brumari Brewing Company for 4 years, from 2016 to 2020. And as of January this year, I am Crooked Stave's head of finance. So I'm located in Asheville, but I am their CFO. So I travel to Denver quarterly to do a major financial review, but I am their remote CFO. And I absolutely love working with Chad. I've never learned more about Britannomyces in my life in such a short period of time. I'm also a home brewer. Sam, being my first boss in beer, really inspired me to start home brewing. And Saisons are my favorite style to brew. I have a single tier rib system, half barrel system. And our dog's name is Simcoe, and our cat's a porter and stout. So beer is everything. It is a huge part of my life. I eat, live, sleep, drink beer all the time. I also enjoy teaching about financial concepts. I teach at the University of Vermont in their craft beer business brewing program through AB Tech and our local CDFI Mountain Bismarcks. I write for the New Brewer and Brew Your Own pretty often. I partner up with John Hall for the Nano podcast, and I also serve on the finance committee for the Brewers Association. This is my third year in serving. So we're going to go through today, why am I teaching this class? Why is such a need for a class that I saw within the industry? We're going to walk through the key components of the cash flow statement, and then I'm going to take you on a step-by-step basis in creating a cash flow using the indirect method according to GAAP. Most of the time, you are used to seeing cash flow statements that are direct method, so raw inflows, raw outflows. I'm going to help you use the indirect method and show you how to construct that on your own, because I feel it's a lot more intuitive for you and gives you a lot greater control over your business. Then we'll walk through some best practices in managing cash flow and working capital. We'll talk a little bit about what burn rate is. If you're talking to the banks and you're looking for expansion capital, or you want to move on to your next phase, what does that mean? Let's talk in the same language and the same level. And then we'll also cover the debt service coverage ratio, because that is key. Key component that the banks are looking at, the investors are looking at. How do we calculate that? How do we know how well we're doing so that we can adapt our behavior as needed? And hopefully we'll have some time for Q&A, but because we got started late, we might not. So you'll have to find out, be floating around through the rest of the conference and the awards tonight. So kind of not difficult to locate me with blue hair. Feel free to pull me aside as needed. So why am I teaching this class? Cash flow statement and income statement are not the same. I understand that we had that session yesterday. The first session that we had, they wanted to make sure you can't equate both of them together. But you can't really fault us into making that mistake, because many of us go through SCORE and our local CDFIs and getting that free business education, getting those free templates so that we can get our businesses started. They often mesh both statements together. You'll see them all in one complete statement, which will be your P&L as well as cash flow, or they'll combine them. So it's not really our fault, but that's often the case in how we get things started. But we have to make sure that those are different, because you can show positivity in cash flow and a loss. And likewise, you can show a profit on your profit and loss statement, yet be undercapitalized and cash flow deficient, ready to close at any day. I was working with a brewery in California. They called me up, the owner calls me up and says, "Hey Audra, I don't understand, what's going on? I'm trying to sell my business as a 7-barrel system. We've shown a profit of over $40,000 over the last 3 years. I have cash in the bank. I'm doing really well. Why is nobody interested in buying my business? I can't fathom why nobody would. We're profitable. Come kick my business, come buy it." Says, "Okay, let me do a little bit of forensic accounting, dig into your financials. We'll see if there's anything that I can uncover." I got his cash flow statement. I created a cash flow statement for him, but then I was taking his balance sheet, income statement for the previous 3 years, looked at his tax returns, started piecing things together. Despite him showing a profit and cash in the bank, the inventory balances from month to month and year over year were slowly rising, especially with raw materials and finished goods. So those balances were creeping up. Didn't know why. He did not know why. But we did a little bit of digging, and I find out that there were no regular counts being done. No end-of-month process to true up what the balance was saying that they had on the floor versus the books. Had to match those up. When we do our tax return once a year, when we have that completed, He said, well, the CPA just asked me for what the balances are. Well, the CPA's responsibility is not to validate the inventory balances that you have on the floor. You're supposed to just give them the numbers, and then they complete your tax return, unless you engage them to audit you. So they'll just take the balance of what you have and work that into your tax return. So we did a little true up, recounting the balances on the floor, and all of a sudden, like, you realize, oh wait, I have way too much inventory on my balance sheet. I didn't recognize all the losses, all my production losses that I've had over the years, all of the items that walked away that I comped. And so we had to adjust that, and that cost moves over to cost of goods. Goes from the balance sheet to the income statement. Likewise, looked at the balance sheet. Sure, he has cash in the bank. But how has he obtained that cash? Where is that coming from? It wasn't from internally generated operations. He was taking out short-term loans, high-interest short-term loans, to service his current debt load. So yes, he had cash in the bank, but it was because he took out a loan and an additional loan 2-3 times in order to pay off the first loan, then the second loan. So that, of course, gets carried on the balance sheet, and you don't see any of that reflected within the income statement. So when I constructed his cash flow for him to give him the full picture of his business, he realized really quickly that once we adjust inventory and once we put your debt service on the books, he's not showing a profit, he's showing a loss. And not only that, he's about to run out of cash yet again. His operating model was not sustainable. If he was focused on the income statement, I was like, I'm profitable, I swear I'm showing a profit, without focus to the balance sheet, when you put them both together, it was a completely different picture. Nobody wants to buy a business that is losing as much money as it is, despite what he insisted. Likewise, I was working with a brew pub in Virginia, and over the last 3 years, they were showing losses on their income statement. Constant losses. But they were successfully able to secure expansion capital. Why was that the case? Well, when they opened with a healthy cash reserve, bank balance that they had, and the owner was ready to inject additional capital if needed. So he had some money on the sidelines, he had some investors, and he had some family and friends that were willing to put money in the business. Cost of goods sold, despite the company still showing a loss, cost of goods sold was slowly decreasing over time as they were recognizing the economies of scale. So as they were continuing to grow, despite them still showing losses, that COGS number was trending in the right direction. They were taking inventory on a regular basis. They were turning things up on a monthly basis as well. Their demand was exceeding their supply. They had 2 wholesalers fighting for their business, wanting to get the distribution rights, and they couldn't make enough beer. And the demand continued to grow. So we put a letter together, a letter of intent from the wholesalers, and saying we definitely want to have the rights to this brand, but they need to have a 20-barrel system. They need to upgrade their system altogether. We want to help them get there. So when we pulled all that documentation together, give them a much more holistic view of the enterprise. Despite the business showing a loss, they were trending cash flow positive, and got the loan that they wanted to have. So $850,000 of expansion capital, and that allowed them to go to the next level. So the point in saying that, and the takeaway really is that you can't equate cash flow positivity with necessarily an income, and likewise, a loss does not necessarily mean negative cash flow. They can be inverse, and it's important that we be able to have the full picture when we look at our entire business, our brewery. The cash flow statement is the least intuitive of the 3. We all know that. But it also gives us the greatest amount of insight within our business operations. It serves as a bridge between the income statement and the balance sheet. It pulls them both together so that you have a full view of how things are moving. We just tend to focus on the income statement a lot. When we're looking at our annual budgeting process, what are we doing? We're looking at P&L. We need to be able to pull in the cash flow statement as well and focus on the cash flow and positivity, gaining that not just looking at P&L by itself. The components of a cash flow statement are the operating section, the investing section, and the financing section. So cash flow that is used by, generated from operations, these are going to be your month-to-month changes in your current assets and current liabilities. Current meaning comes due within a year, or you are expecting to convert it into cash within a year. Those top side, the top part of your balance sheet within the asset section, the top part within the liability section. So those changes from month to month, operating activities. The three big categories: inventory, accounts payable, and accounts receivable. Changes in investing activities are going to be you purchasing assets and investments, putting investments within the brewery, and selling assets from the brewery. So purchases of equipment, purchase of a canning line, selling off a used keg cleaner, keg washer, things like that. That's what moves. That's in the investing section. And then the financing section is where we manage all of our debt, as well as our dividends and payouts to the owners. So line of credit, any type of loan we have with the SBA, any other private investment that we have, the payback of that, as well as the payout of the dividends. I like to equate those three layers within the cash flow statement to a creek. When we look at a creek, the fastest moving water is on the top. The water, as you get deeper into the creek, the water moves more slowly. It is also more easily, we can be more easily nimble when we're on the top of the creek than we are as we're flowing and walking through it. So think of it that way, of like when we're looking at the operating section, the top section of the cash flow statement, this is where we have the capability to make the changes that we need the fastest, the quickest. It's where we're going to be the most nimble, so that we can move the direction of the entity of where we need to go, so that we can strategize our investing activities and our financing activities. The cash flow statement is also used to assess the quality of a brewery's earnings. So when it comes time to evaluation, if you are accepting a partner within your brewery, if you want to buy somebody out, you typically have an evaluation done. When I do evaluation of a brewery, I am looking at the cash flow statement first and foremost, because I'm looking at projections from a discounted cash flow analysis perspective. I look at the market methods, I also look at income methods, but cash flow is king when I'm doing evaluation for a brewery. I want to be able to see what the free cash flow is. What kind of cash flow are you generating from your operations day to day? Free cash flow being defined as the difference between cash flow that is provided in the operating activities less investing. It represents the cash that's available for the brewery to repay creditors or pay dividends or interest to the investors. It also reconciles our net income on our P&L by adjusting for non-cash expenses, the changes in working capital, which is current assets minus current liabilities, and then capital expenditures. So let's take a look at this brewery, ABC Brewing. Here's their cash flow statement. Nothing's really happening here, they're just bebopping along as is, and they're generating losses from the top line. If they're not going to make any sort of changes within their activities, they're out of cash by month 3. Goes from black to red. All right, so let's see how we can change things when we pay attention to cash flow from operations. That top section, the one that we have the ability to control and maneuver within most easily. First, looking at increases, decreases, accounts payable down here. We renegotiated some credit terms, so where we had to pay COD, or we normally would just pay things out because we don't like to have obligations on our balance sheet. We're going to negotiate some credit terms that we have with our vendors. Likewise, we're going to look at the ones that we have, let's say that are net 30, net 45, net 60. We're going to adjust the timing of those payments to match those terms. The longer that we can keep that cash within our house, the more we can do with it. So let's say you have a net 30 payment rather than paying it on the second or third day for the sake of a 1% to 2% discount, which often is the case when we work with our raw material suppliers. We're going to pay on the 29th day. Still within terms, but we're going to extend and push that out as long as possible. That way we can keep that cash in-house. So when we did that negotiation and we push out the adjusting and the timing of the payments, we keep some more of that cash in-house and generated a positive inflow as a result because we're hanging on to it longer. Then we look at changes in accounts receivable. First thing we do is review all of our 90+ day balances and make the effort to collect as much as we can by contacting those that are owing us money. Sometimes people just forget to pay their bills. But if we just let it hang out there, all we do is most of the time is just make one reminder to them and say, hey, just checking in on the status of that invoice. Oh, I never received it, or I totally forgot about it. That's cash that's just hanging out waiting for us. So make that effort of anything that's 90+ days, and in this case, we had a wholesaler that missed a payment. Oops, they were like, we never received the invoice. So sorry, let us pay you that immediately. That's that $24,100 payment coming in. And then as a best practice, as a result of having had to adjust things with that wholesaler mistake, we said, hey, it's okay, you forgot to pay this invoice, but can we set up a direct deposit with you, Mr. Wholesaler, so that it pays us immediately, draws from your bank account into ours on the 15th or the 30th, whatever the day is that you set by your agreement. That way it takes the thought process out from their end, and now you can regulate your cash flow a lot more regularly because you're not waiting for that check to come in. And then you're taking a lot of uncertainty out of that mix. So accounts payable, accounts receivable, some changes that we could make immediately. And then finally, inventory. Reviewing, this brewery then reviewed all of the inventory balances that they had versus what their true recipe needs are, and culled out the stuff that was old or obsolete. So our recipe changed. Our hazy IPA now uses a completely different hop profile. We can eliminate these two different types of hops, and we don't need this malt anymore as well. Really refining our recipes and matching what our inventory needs on the floor are with what we have. So sold off those old hops on well, they weren't necessarily old, but outdated for us and no longer necessary. We sold them on the Lupulin Exchange. And then some of the malt that we no longer needed, and some of that Sriracha Ace, sold to local homebrewers. So that helped us with a little bit of a bump in the cash flow there. So you can see in the highlighted line item, sold some hops out, and then sold some malt and a couple of old hops out to our local homebrewers. So we polished up things that we have on the floor. Those are the three main categories where we can alter our behavior, and look what happened. As a result of paying attention to accounts receivable, payable, and inventory, it bought them 3 months to figure out a plan. So no longer they were going to be running out of cash in month 3, they could go all the way to month 6. What does that 90 days do? It allows you to put another plan in place. Well, how are we going to figure out we're going to have to change how we're operating things, but also let's develop a strategy as to what we're going to do with our cash flow planning so we don't find ourselves in that position where we do have to take out a short-term high-interest loan for 27% interest or something equally ridiculous because we were caught off guard. This bought us some time. So when we look at those categories within the balance sheet, in the first section right there within the cash flow statement, magic starts to happen. So constructing your cash flow and doing this yourself, most of you that are smaller are going to be using QuickBooks for your financial management software. What I recommend is that you take your QuickBooks, export your income statement and your balance sheet by month in Excel. By month, not by total. And then ask your bank for your amortization schedule if you already don't have it. Some of us don't really get one from the bank. We just sign the paperwork and it's sort of like, well, we'll just have the payments drawn out of our bank account regularly monthly, but we don't have an amortization schedule to match up with that. So grab that if you don't have that already. How do we construct the operating section? All right, so we have our income statement and balance sheet by month. From the income statement, link the net income as that top line. That's the very first line within the cash flow statement. And then you add back depreciation and interest expense. Why these are non-cash items? You're not writing a check to the asset company, when you're recognizing depreciation and expense or the loss in value of your asset. So it is non-cash flow. affected. So we want to make sure that we add that back to net income. And then likewise, add interest expense back as well. Because when we subtract that monthly payment that we have for debt service within our financing section, that has interest already included within it. So we would double count it if we left it back in. So add back depreciation, interest expense. And then, from that point, you use the balance sheet to link the ending balances for inventory, accounts payable, and accounts receivable, month to month. Pull the ending balances in. That's going to be your changes in accounts receivable, your changes in accounts payable, and then your changes in inventory. And I left you a key of what that means, the difference from month to month, because even I as an accountant sometimes have to think through the order of that. An increase, for example, in month to month from accounts payable is positive on cash flow. That's because we're not putting that money out there and paying those bills at that point in time. So when our balance increases from month to month, that means it's positive for us. We're generating cash flow internally or conserving it. Likewise, if your month over month balance in accounts payable drops, that means you paid off more than normal. And so that's a negative effect on our cash flow. Accounts receivable, if that balance goes up, that means we didn't collect the cash in time where we needed it. So that's a negative effect. And likewise, as it drops, it's a positive effect on cash flow. So the biggest challenge that I see, and I see for people, me too when I was an accounting student initially, was that you have to stop thinking in terms of raw inflows and outflows and start thinking about the changes from month to month instead. We're going to have a fixed amount of money that goes out the door regardless of the level of production. Rent, insurance, there are going to be items that whether we produce 0 barrels or 500 barrels, we're still going to have to pay for. So getting a hold of that number, you know that's going to be steady from month to month. And then what you really look at is where you can change things. When can we spend a little bit more? When can we collect more aggressively to be able to affect that change, that delta from month to month? So that's why I say it's more intuitive in terms of controlling your business and gives you better insight by using this indirect method, is that you can predict things more clearly that way, and you do see where your behavior truly affects the cash flow statement. So likewise, inventory increasing from month to month, that's going to happen. The seasonality of the business demands that. But we're typically purchasing those ingredients for beer that we're not going to sell, another month or two down the road. But we have to buy that up, build that up so that we're ready to produce more beer for those high times. And likewise, we'll let those inventory levels drop from month to month when we know that we're approaching the slower times. We can slow the purchases of additional raw materials. So we'll have a fixed amount that we have from month to month, but now what you're doing is really controlling that ebb and flow instead. So that's really what one looks like here. You'll have the presentation too that we'll send out to you, and of course, grab my card if you have any questions on how to construct one. But there's depreciation, amortization is added back, interest expense is added back. This example was a brew pub that I put together, so they don't have any AR, accounts receivable, because they're selling 100% of their product over the bar. And accounts payable, they were going on a cash basis, so they didn't really have changes from month to month, so I didn't include, there's not one included in there. But the additions and depletions of inventory, you can definitely see that they were ramping up for May and June being their high times because they're increasing their purchases. So their cash outflows and inventory are greater during months for March and April. They're getting ready to ramp up. And likewise, it's positive when things slow down. So in Asheville, for example, the spring gets busy, we die off a bit, July, August, and then leaf season pops up, Blue Ridge, changing colors. October is our biggest month in sales for the entire year, for pretty much every restaurant and brewery in town. So you'll start seeing and being able to map the seasonality of your business just looking at your cash flow and understanding why those changes are happening. And in this case, when we constructed that cash flow for them, and why would you do it? It's really going to help you project moving forward, is that I wanted to make sure that they would have enough cash in the bank for their expansion to I'm going to create and project my profit and loss statement for the next 12 months. That's what we do with our annual budgeting process as well. But now we need to add the cash flow statement in there because then we can determine the affordability of our ability to be able to invest back within the entity. So I'm taking you through how to do this on a step-by-step basis. You're looking at historic statements because I want you to get comfortable with the numbers. But the objective of this, not just to give you a more clear understanding of how the cash flow statement works, is for you to gain confidence and understand how to project going forward. Because QuickBooks is terrible with that. And that's another reason. You'll ask, well, QuickBooks has a cash flow capability. They'll generate a statement of cash flows. They will, but one, it's laborious, cumbersome, it's way too detailed, and it can't project forward. QuickBooks trying to use that for projections is a joke. I'm not even kidding. So we want to make sure that we're understanding where the numbers are coming from so that we can start projecting that cash flow ourselves. So in this case, we can see, okay, I want to expand it in 12 months. Will I have enough cash in the bank to do it? And according to what we were projecting for our net income, we would. We would. And this is another item that I add at the bottom of the cash flow statement. It's months of cash on hand. So we're looking at what our normal operating expenses are from month to month. And then taking that number, knowing what our fixed overhead number is, dividing in that number into what our cash balance is going to be. It's going to tell us how many months of operating expenses worth that we have on hand. Best practice, make sure you have 3 months worth or higher. If it dips down below that, we might run into some problems if we have a disruption within our operations. So these guys internally generate a little over $200,000 over the upcoming 12 months. When they purchase that internally themselves, it still leaves them with 3.4 months of cash on hand. Safe. I'll give them a thumbs up. That's how we start planning. So we went through the operating section, the investing section. You use your balance sheet to link month-end balances for fixed assets to reflect the purchases, as well as the sales of equipment. So increase from month to month on balance sheet means it's negative on the cash flow because we're purchasing items. And likewise, if it decreases from month to month, it means we're selling some of our equipment, positive cash flow. And then financing section, you're either using the amortization table from your bank that you got, that schedule that they give you, that's this beautiful little grid with principal, interest, and total payments. But if you keep up with that, you don't just let it come through as a link from your bank account month to month and truly recognize that expense in there, you should be able to use the balance sheet to link the month-end balances for long-term debt, as well as for any dividends paid or draws that are made by the owner. And the final step is that the beginning cash balance in month 1 should be your reconciled bank balance of the operating account for the last day of the previous month. So let's take a look at that again. This beginning cash number is $175,541. Let's say month 1 is January 1st of the year. That balance is $175,541 is the December 31st of the previous year reconciled balance. So that you've adjusted your books, QuickBooks, to what it states in your bank, reconcile that out, that's your starting number. And then you just let the math do the work for you from that point forth, pushing it forward. Some best practices from cash flow management over the short term. Understand what your fixed overhead is. That number of your cash outflow, what it is that you're going to spend regardless of level of production. You're going to have a fixed amount. It will be the set amount that you have. Understanding that helps you with future projections, but also in setting benchmarks and KPIs within your own dashboard to make sure that you're meeting those metrics moving forward as well. So know what your fixed overhead is. As we're going through today's session as well, managing your inventory, accounts receivable, accounts payable. Those are the things that you can change the fastest, can affect the most quickly. Make sure that you're active and stay on top of that. Use your tech to your ability, to its ability, not to yours, to its ability. Make sure you get the support that you need so that you have to minimize the amount of workaround solutions you have to do. We pay a lot of money for our ecos. We pay a lot of money for Arrived. Get familiar with how to use it. Get support because they give you support specialists specifically to work with you. And eliminate, automate, and consolidate those processes whenever possible. So we buy these products to help us do our jobs. Once we have to start doing workarounds, it means something's broken. And most of the time, it's just the level of education that we have isn't there, or we're not getting the support we need. So, hold those software companies' feet to their fire and get the help that you need and make sure you get the numbers you need. Focus on generating working capital. Working capital is current assets less current liabilities. But it's the cheapest form of getting cash because it has no conditions, no interest. It's internally generated from your own operations. And then just even as a starting point, calculate your liquidity and efficiency ratios. So your liquidity ratio is going to be your current assets, your current ratio, current assets divided by current liabilities. Your quick ratio is going to be your current assets less inventory and prepaid expenses divided by current liabilities. And efficiency, inventory. Oh my goodness, inventory turnover. We definitely need to continue to focus on that. As an industry, that's the bread and butter of how we operate. And that is calculated as cost of goods sold divided by average inventory. So we want to know at least what our starting points are. I started working with Crooked Stave in January, and so I did all of their benchmarks, and I calculated these ratios for them. And I calculated the inventory turnover ratio. I was like, okay, this number looks way too low for me. Like, how can it be this number when most of my breweries are much higher? Well, that's because of their wood program. And then they have generally different types of beer that they have, but they've largely focused on wood. So that is going to be sitting in there for 8-9 months at a time, because that's the dominant part of their portfolio. What I found to be the much more helpful metric was separating out their clean stainless beer from their wood beer and calculating efficiency ratios, the inventory turnover by separate category, because you can't manage them both together. Completely different animals. But it's good to know what that starting point is. When I calculated that ratio initially, I was like, we have some problems here. But we didn't. It was just that getting to know their business model and separating it out, like, okay, this will adapt how we calculate these ratios to the actual business model. So one size does not necessarily fit all. But you should, at the very minimum, know what your current and quick ratio are, as well as your inventory turns. Over the longer term, align your overhead spend with your future demand versus your current. Review those pricing contracts, your hops contracts, your BSG, malt group contracts. We talked about eliminating, automating, and consolidating. That's short term, but as well as over long term. We want to be able to minimize the duplication of efforts. And then evaluate all your capital projects using cash flow via NPV analysis. Last year, during the virtual session, where I taught through this conference when it was virtually, I was in Apalachicola, Florida, and we were probably watching the sun slowly burn my face over the course of the hour while I was sitting in front of a seafood processing plant with the only point of Wi-Fi that they had in the city. We whacked through that whole process of how to calculate, how to hack Excel, use Excel to your capabilities to determine in a pragmatic fashion the order of how we should invest our cash within our project over the long term. So I think they're still recorded. Definitely take a look at that. That's going to be really helpful. So that, for you to give you just a pragmatic way of investment strategy. And minimize pricing erosion, especially now with our inputs, like our raw materials and our cans are going up over 20% in cost. Now's not the time to be cutting deals to try to up the volume of beer that you're selling, because it's going to be a lot more difficult to raise price after you've lowered it even more, or you've run some deals. And don't forget to use divisional accounting to track profitability by each arm of the brewery. So if you have a wholesale arm, a distribution arm, and taproom income, you really have 3 lines of business within one business itself. So you want to make sure that your revenue line items are stratified accordingly to that arm of business, as well as cost of goods categories matching up to those arms. I can't tell you how many times I come and I look at to do an operational audit, and they'll have sales, and they'll have them all really nicely stratified, categorized, and then cost of goods, one bucket. That's it, just cost of goods. Well, how do I know if one arm of the business is subsidizing another one, because I cannot separate out the profitability by that business arm? So basically, if you have 3 lines of business, if you have a restaurant, that's a 4th one that also has its own set of benchmarks to work through. Then make sure your cost of goods are matching up those categories so that you could create, in effect, mini P&Ls for each arm. Periodically review your chart of accounts. We don't do that enough. Our industry is evolving so quickly in how we create products and how we decide, like, packaging options, the types of products that we offer. Our metrics, our success metrics, and what it is that we want to accomplish as a company are changing as well. And if we don't change the chart of accounts accordingly, we're not going to be pulling the data that we need in the timely fashion, and it'll start to become obsolete. And our financial reports are going to be less impactful because they're not moving along with the evolution of our business model. So review your chart of accounts. I usually do it annually, and that's enough. Review your point of sale entry as it relates to the accounts in your chart of accounts. Make sure it loops into the back end of your chart of accounts to your point of sale. So if you have something from Arrive and you have 5 different categories that you like to track, make sure your cost of goods in QuickBooks has those 5 categories separated out and map them together. Sync them if possible. I can't tell you how many times that I've had that, like, they'll have Square or another point of sale and they just link it to their bank account, and the journal entry is that's it. Cash that goes in the bank is sales. No. Because that also includes tip income. And tip isn't truly income to us. We are holding on to it and then paying it back out so that we could potentially be overstating sales if we're including tip income within our sales category. So just review your point of sales entry periodically. I would say not more than once a year as well, to make sure it's still looping into those correct accounts in the back end. Sometimes bank syncs break, and then when they reconnect them, the mapping is lost. So just something to keep in mind. And then culture, looking at it not only from a holistic view of the enterprise, but the culture itself. How are you information sharing within everybody that's working alongside you? I spoke at CBC about open book management back in September in Denver. I'm really passionate about it. We practice it at Crooked Stave, and I know that Odell practiced it to a degree. There's also a system called EOS, Entrepreneurial Operating System, and that is based on the book called Traction. It is another way that you can systemically share information within everybody at the brewery that's in a very structured fashion. So you become very efficient in information sharing, you elevate everybody's financial literacy, and you do it in under an hour or less weekly. It just opens up so much more in terms of communication channels. So open book management is also the great game of business. It is a book from Jack Stack. There's an updated version that's out there. It doesn't necessarily going to affect every single brewery. You don't have to pick everything out of that playbook and apply it to the brewery. You can cherry pick for sure. But the point is to elevate everyone's financial literacy level so that they understand where they fit in within the brewery and how their actions impact the financials, and then you get to see the financials and see the impact. And then celebrate your successes together. Burn rate is measuring how quickly your cash holdings are decreasing. So we hear about gross burn rate. Net burn rate is really what we need to focus on. That is your cash outflows less your cash inflows. What burn rate, and understanding what your burn rate is within your specific brewery, it allows you to forecast when you're going to run out of cash or when you're going to be able to expand. So the sooner you know that, the better, and that comes from constructing your own cash flow statement. The goal, of course, is to show a negative balance. We want cash inflows to exceed cash outflows. So best practice is understanding what your fixed overhead is. You're going to have a certain amount that you're going to be paying out every single month, regardless of level of activity. Know what that is, and then any sort of excess balance you're getting from your tap room, from wholesaler sales, I like putting in a separate savings account to earn interest. Right now, we're not earning much interest, but it's something. And it's somewhat of like an out of sight, out of mind thing. Like, my breweries have a tendency to If they see that they have a whole bunch more cash in their operating account, they're like, I want to pay off all the debt immediately. I'm going to buy additional FVs immediately without thinking through, well, when the slow season comes, am I leaving myself enough cash in the bank so I can still operate through that slow season? I think the point of that more than anything is that spending more is not a bad idea, but separating out that excess from what your fixed amount is going to be is going to allow you to do it more mindfully. We'll plan for the future. We know that we still have enough cash in the bank, but we know what that excess is. So, hey, do we want to invest it in X, Y, or Z in the next 6 to 12 months? Yes, let's do it, but let's make sure that we don't dip down below that fixed overhead amount and short ourselves on cash 6 months down the road. So what we did with one of my breweries for PPP funding is that we just opened a separate account for them, put the PPP funds there rather than the general operating account, and then pointed all working capital items to come out of that account. So all of our malt, all of our inputs, as much as I could with rent, insurance, everything that was day to day, so that I could free up as much of the payroll as I could for the employee retention credit. Because you can't double dip, but you want to be able to stratify both, separate them both, and make sure that we were realizing the greatest benefit for the brewery in getting that money. Some of the breweries were just like, we got PPP funds, we're just going to spend it all on payroll. That's it. We don't have to document anything that way, it's easy, but then they lost out on the benefit of the employee retention credit. So we just separated everything out, and we had a clean journal entry that would go. It would just point directly to that PPP amount, and we paid all of our bills through that rather than through the operating account. Close that out, and we have a very clean paper trail that we, in case we ever have to defend it to the IRS. And then finally, the debt service coverage ratio. This is key for all entities, regardless of whether you're in projections and startup phase or expansion. This is a key number to know. It is the first number that a bank will look at when you're creating projections that you give to them for financing. The very first number. It is calculated as EBITDA, which is earnings before interest, taxes, depreciation, and amortization, otherwise known as net operating income, divided by total debt service. Debt service being principal and interest together for the year. So what I like to do is that when I create projections, I have an amortization table that shows me my monthly payment. And then when I'm doing my projections for 36 months on the profit and loss, I can sum up my EBITDA for the year, and I have a total. And then I have the amortization table, and I take 12 months, those 12 payments in there, and I divide one and the other to make sure that my EBITDA has to meet a minimum threshold in order for this project to be financed and to gain funding approval. That number needs to be 1.2 or higher. Thanks so often tell you that. I work with United Community Bank a lot. I work with Live Oak. 1.2 is the magic number. Hit that number and you're golden. Let's say you hit 0.95. That just means that you can only pay 95% of your annual debt obligations, which would include that long-term debt. Not good enough. The bank will not approve you if you have a 0.95 number. They also look at it from the perspective, like let's say you're currently operating and you want to go into expansion mode. They're going to look at what additional amount of debt that you're going to be taking on, add that into the debt service, and make sure that you still meet that 1.2 number or higher. Because you'll have higher elevated projections as a result of the expansion, so you're hopefully showing more profit. That magic number is the one that you need to hit in order to get approved for a loan. So, I know I zoomed through this because we got started a little bit late, but I know cash flow is not the most exciting part of a brewery. Accounting is not exciting. I get it from a lot of people. I get excited about it. I freaking love it, but especially as it relates to beer. But hopefully you learned a few things along the way today. I really am grateful to be up here in Albany with you from Asheville. If you find yourselves in Asheville at any time, look me up. Happy to buy you a beer. Come join in our culture down there. And I have cards. Obviously we don't have time for questions now, but I'll be floating around the conference the rest of the day too. And so I thank you for not falling asleep. And I appreciate you being here. Thank you.